Hey, thanks for having me, Richard. Excited to
Great.
be on.
Hi, great. It's my pleasure. So I'm gonna jump in right in to the topic. I saw in your bio, I saw that you're doing great works. I know you've exited several businesses. Talk to us about your experience with that.
Yeah, to date, I've sold five businesses. Businesses that, so take a little step back. We're an investor, but prior to that, I was a startup founder and, really have gone through the process. And this has been over the next last 10 years. So started my first business in 2009, 2010, raised VC money, and then we transitioned to the investment side in 2016 and have since then been helping run, help build, help sell businesses. But of course, it's the natural progression when you build a tech business, when you build a venture-backed business to have a liquidity event. And of course, that is going to be, selling the business, whether it be partial, whether it be, there, when people talk about a business being acquired, it's not always a straight line. There's always multiple ways. Like, is it a stock deal? Is it a majority deal? And so part of what people have to think is what is that process going to be? But more importantly, you don't, the kind of the fallacy that people understand is you don't sell a business overnight. It takes anywhere from 6 months to a year with another 1 to 2 years of prep time.
And so were all those businesses tech businesses that you were involved?
Yeah. I've been a lot of, on our end, it's been a lot of tech businesses. I've helped also some individuals sell a couple of software development businesses, just advising them on how to structure a deal. Usually, friends that I know, I'll give them advice on, hey, maybe it's a software license, maybe it's not an asset sale, maybe it's not. And I think in that case, part of it is that, as I said, it's a very unique formula. You're going to get to the end, but how you structure the deal is as important as the deal itself. And so for like a interesting case, like years ago, when I was had a startup, there was a friend of mine who had a business that was doing professional services, but had some software, and he was approached by someone that says, "Hey, I want to sell the business." And he came out, reached out to me and said, "Hey, great news. Someone wants to buy the business." I said, "This is awesome. Congratulations." He came back to me and said, "Well, guess what? Someone wants to buy the business, but they don't want the customers, but they want the people, but they want the software." So we then kind of went back to the drawing board and said, "All right, you can't sell the company in whole because they want parts of it, they don't want the whole thing." So we structured that acquisition as he would sell them a perpetual license of their software for millions of dollars, and they took the people. And so he was left with a company with no staff, software, and customers. So he actually called me to help build back the business to then sell it again. So, it was really an interesting solution because one of the things that he did do is he said, well, what he did is he bought all the employees out so that they would have a liquidity event, and he used it to be own 100% of the business. So next time it sells again, that liquidity event 100% goes to him.
What's the difference between because I see exit and sell. What's the difference between the two?
So when you sell, there is, let's say, a cash liquidity event. And so this is what you have to look at. That's just like someone gives you cash for either the book of business, the assets, or the entire company as a whole. It's a transaction. Like, let's say you're making a cookie business and someone's like, "Hey, I want to get into the cookie space." They're going to buy everything. They're going to buy you. They're going to buy the machines. They're going to buy the building. They're going to buy all of it. But usually in tech, it's a little different. Acquisition may not actually mean cash exchanges hands. In the most cases, what I've seen, it is either what's called an asset sale, whereas there's a portion of something that somebody wants, like the software license. There may be cash. A lot of times, what we're seeing now is it's a stock to stock deal. Larger company comes in, maybe making 5, 10x more revenue. They're buying the book of business. They'll actually exchange their stock for the company stock. So if it has investors, then investors get stock in a new company. If you're the founder or you're the employee, you get stock in the new company. In that case, the new company may have more value combined because let's say in our case, we had a business that was making 20 million in revenue. Their biggest competitor was making 50. Both CEOs called each other and said, "Hey, we should merge." And now they closed last year at about 80 to 90 million in business. Again, no cash stayed hand, but it was one of those 1 plus 1 equals 10. Like it really was, it helped up the value of both businesses. And in that case, that's more of a strategic acquisition.
So when you talk about merge and acquisition, is that an option too? That's another option.
Absolutely. It is another option. When you have a merge, it's more of a merger of equals. When you have an acquisition, there's always a lead, there's always a follower. So when you're looking at that deal structure, like we've had two acquisitions that were mergers because it was one had customers, the other one had cash. Boom. They were like, we're as equal as each other. And that's a good start. When it's literally tipped on one side, you know a couple of things are going to happen. And the hard truth is, there are things on this side that may be redundant. The new co doesn't need a CEO. They don't need a C-level executive. The founder may be redundant. They may just say, "Hey, I want your IP, your intellectual property. I want your book of customers." And so in that case, when it's not a merger of equals, you're going to see a cleaning house of employees, a cleaning house of management, a cleaning house of founders. But in some cases, that's maybe what they want. It's a potential, exit for them. They keep some shares in the new company. Maybe you buy them out with cash. But that's why I said it really depends on both sides being happy with what they're getting.
So why do people do mergers? Is that the reason or
Yeah, just because in that case, you have two equal parties. You have two equal businesses that they look at it and say, there is absolutely this synergy. Because if we come together, we're either going to double our revenue, we're going to be combined. In the case of that business that merged with the other one, the number one and the number two business in the space now became the number one. Because of that, it killed off all the competitors. And it was really incredible to see because this is what they theorized. They said, "Hey, if we're the number one and the number two player combined forces, not only are we going to get more revenue, not only are we going to grow our company, our book of sales, our employees, we're going to kill the rest of the market." And they did. And it was really tremendous, super strategic. There is another term is let's say there is not a merger of equals and the gap is pretty wide. This is what you refer to as a fire sale. That means the person down here wants to get out of the business at any cost. Maybe they're insolvent. Maybe they can't raise any money. Maybe they're just in debt and they just want to sell it for anything.
do you think from your experience, do you think people for the most part overvaluate their business?
I think so too. It's interesting that I kind of see this gap in the space. Either people ridiculously overvalue things or they ridiculously undervalue these things. Interesting because usually in tech, like people are overvaluing business. I just talked to an AI business and they were like, "Oh yeah, we're not going to take less than 50 million." And I was like, "Wait, what? How much are you making in sales?" 66K. And I was like, "Yeah, you're not worth 50 million. I'm not going to do because usually the equation is going to be based on two things. It's going to be a multiple on revenue or a multiple on EBITDA, net revenue inherently. So sometimes in tech or in consulting, you base it off gross revenue. Hey, I might make 5 million. Maybe it depends on the space. There may be a 5 to 10x multiple. But when you look at something, let's say a family run business, let's say you're in the food space, you're in manufacturing space, you're going to base that mostly on EBITDA. How much is cash flow? And usually based on cash flow, you are really going to do a lower multiple, maybe 1 to 5, because part of the biggest risk in that is, let's say you buy a family run business and there's the father, the son, the child after that, they've all been running the business, but you lose somebody, somebody passes away, there isn't a good succession plan, then even though you be making 5, 10 million in EBITDA, without that person, without that book of business, without that IP, without that knowledge base, it puts the sale at risk because someone may not be there. And so usually this is what like a private equity fund wants to do. They want to find businesses with low multiples, buy them for 1, 2, 3x, combine a bunch of businesses together so that they're not just making 5 million. Now they're making 50 million combined. And at 50 million, you can say, oh, this is a higher multiple between 5x to 10x. When you look at private equity, like that type of approach, the highest I've ever seen is 13x. And that was because they literally spent years cobbling businesses together to say, yes, look, not only is it one company, but it's revenue and it's all this customers and national in order to get that level of a multiple.
Uh, when you talk about multiple and EBITDA, is it only those two ways to evaluate a business, or there's other ways?
It's really hard because let's say in one of those sales, like I had a team that I was helping with due diligence, and I said, here's kind of the three things you have because every business owner, every startup founder, what they always need to do, regardless if you're ever going to sell or you're not going to sell, is you always want to keep an idea of what are your assets? What do you have? What's special? What do you own that no one else has? What do you just own? So this business, I said, look, let's look at this, these three pieces you have. You have the bodies, you have engineers, you have designers, you have executives. That is a fixed expense cost. That is like maybe you're not paying full price for them, maybe like their salary's a little lower. So what you do from an exercise is if a new company were to go hire them and they were going to pay a recruiter or a search firm to find these executives, to find the engineers, there's a cost value analysis defined from there. So you know exactly that a recruiter may charge you 50% of a person's salary to hire them. So you kind of take everybody's salary, you do 50%, and then you can kind of calculate like a value of what it would take to hire everybody. So we did that exercise and we said, well, there's value in that. The second exercise, and they said, what? We have branding and we have this. And I'm like, well, that's really hard to quantify. Like, and the only way to quantify it is how many customers do I have? Do I have a big waiting list of customers? How much are they buying? Are they active? Are they not active? And that is another way because in that case, if let's say I have, I don't know, 1 million customers, 100,000 customers, there is a customer acquisition cost attached to them. So then you run a same thing analysis. If I were going to acquire 1 million customers times like $1.50 or $3 or $10 of acquisition cost, there is a value that you can back into. So that one is like really it's a little hard, but if you have low amount of customers, but they're paying a lot, then you can try to figure something out, but it's really hard to do it there, especially when you're looking at like trying to define what is the brand worth. And then the third one, which I think is the hardest one, is people say, well, I have software, I have, patents, and that's really, really hard to price because you may be able to say, well, how much was the cost? But was that really the cost? Did I spend $1 million to build this software? That one is really hard to find someone unless they want it and they tell you how much they think it's worth. There actually is a fourth one, which sometimes works, sometimes doesn't. It's just like, how much cash do you have in the bank? Because if you have $10 million of cash, is that valuable to somebody? Is it a 1x multiple? Is it a 2x multiple based on how much they want that $10 million worth of cash? But again, not every business is sitting on a mountain of cash flow. And if they had a mountain of cash flow, they wouldn't be selling the business. So that's kind of how, again, there's no like magic wand of how to do it. The easiest magic wand is someone says, "Hey, Richard, I want to buy your business." And they give you a letter of intent. That's the most, you'll hear it called an LOI that says, "Richard, I want to buy your business for X on my LOI." And it's on paper and signed because I get so many business owners that I meet, so many startup founders that say, "Man, I talked to someone and they said my business is worth this, and that if they were to buy my business, they'd be giving me this." I'd say, "Great, get them to put it on paper." Because at this point, when you have an LOI, then you can go to someone else and say, "Hey, this guy offered me this much. Are you interested in buying the business?" Because you now know that someone has priced it out.
So I think you mentioned before the different ways of deal structuring. I think you mentioned stock or minority, something like that. What about, because when I was doing some research before, when I was preparing the questions, I saw, correct me if I'm wrong, I saw like you could do a lump sum or earn out or equity swap. Is that correct?
Yeah, I think, again, it all based on that LOI. So the first business we ever sold in our portfolio, um, what we did is we actually spent 3 months on that letter of intent and we negotiated all of the terms there. And what we did is, we had come up with a price and the founders were like, "Oh my God, I really want to sell it at this price." And I said, "Look, there may be a way to get more. What if we give you guys a lump sum, everybody's happy, you pay for it, and then you base an earnout based on something, quarter over quarter." In this case, I literally helped negotiate an earnout not on gross revenue, but on net revenue minus a couple of things that said I don't count. And in that case, they made more on the payouts on every quarter than what the lump sum had given them. So it really depends. It's like part of it is to try to be a little bit more creative, but it's also a structure like that is helpful because if the acquirer isn't sitting with a mountain of cash, this is a way of saying maybe, because I think there's kind of like there's either you do a mountain of cash, a lump sum, you do a stock deal, or you do something in between that says, "Hey, I'm going to get some cash, I'm going to get some stock," but then there's an earnings payout. The problem with the earnings payout is there runs a risk that what if you're let go? What if something happens with that new business and you don't collect the earnings payout, over the next, 1 to 2 or 3 years, however it's defined out. So there is some inherent risk in kicking out what that looks like.
So how does it work? Because you see a lot of times when people sell their business, they still own a minority of the business. How does that work? So whoever founded the company, that they make sure that the vision and the mission of the company is still alive.
This is what's called a majority buyout. It's when someone else comes in and buys 51% of the business. The reality is, once you bring in an acquirer to own majority of the business, like you've lost control already. Like there's no way to say this is the vision of doesn't matter. You don't own majority of the business because you now know that that person is bringing in a board. There's now shareholders and that owner is now, inherently working for the shareholders, which are the people that bought the majority business or a board. So it's really, really hard for that business owner to say, because part of it is before this sale, if it's a small business or a lifestyle business, they're making whatever decisions they want. At this point, there is now checks and balances so that they can. And I think that's really hard for a lot of people to recognize that and this is with anyone, as soon as you bring in an investor, as soon as you bring in a majority shareholder, you are, regardless of how big it is, you are still giving up control because these individuals now have a voice.
So what about the tax implication in that?
That's actually a really good question. A lot of it it's interesting because when you talk to startup businesses, people have priced it out. There is a priced round, there is a term sheet that has the price. Every time a company raises money that's venture backed, you're inherently creating a price and you do what's called a 409A valuation that then sets the share price. And so and in that case, the 409A weights how much, revenue, how much, the share people have given you, they've inherently have an inherent price. So there's a price that someone set. It's really hard when, let's say, you're a lifestyle business because you don't have an investor. You're just doing things on your own. It is still recommended to do a valuation process. And that's actually what I see a lot of small business owners, even when they do really well, they never get an outside valuator to actually come in and say, what are the businesses worth? And it's the reason people don't want to do it is, let's say the business is worth, I don't know, $10 million, dollars, you're making empanadas or something like that, and you decide to give the business to somebody, that's now a taxable event. Let's say you pass it down in succession to your son. If you have a piece of paper saying that the business is worth 10 million, that actually may be a taxable event because you're now inherently gifting a business of 10 million. And the IRS in the US doesn't matter, you're still going to have to pay taxes on that gift. But the other way is, let's say you haven't priced the business and you do want to have that succession event. You may be audited from a tax implication and someone will set the price for you. It might be lower, it might be higher, and you may end up having to, pay really expensive back taxes because you've undervalued the business. And that's actually one thing that, especially when you're thinking about an acquisition or a succession, you should at least not every other 6 months or every year, maybe other 2 years, to do a quick valuation of the business with maybe the company CPA, maybe whoever runs the finances, an outside person, just to be like, look, this is not for the granting of equity. This is just for us to know, like, what's the business worth? Because let's say you run a product business and you're sitting on a bunch of inventory and the warehouse burns down, and you go back to the insurance company and you say, hey, my warehouse burns down and I had $1 million policy or $2 million policy. They may come back and say, well, we're going to value the inventory as this because it may be old, it may be this. If you have a valuation, then you can say, no, the inventory was worth $1 million. And by the way, an outside person valued that inventory. So if, let's say, there's a fire, you go back to your insurance company and say, hey, I have an outside valuation. My inventory was worth $1 million, so you have to pay $1 million.
What do you see, what mistakes you see people do in the process when they're trying to sell their business?
So I think the two biggest mistakes are, one, not creating a valuation for the business, understanding like what's it worth. Because part of one of the things that when you create a valuation, and because you're going to have an exit event, um, you're trying to establish cost basis. How much money did I put in? Because if you don't do that and you sell the business for, I don't know, $10 million, then that's a taxable event at $10 million. But if you started over a year or 2 years before and you evaluated the inventory and you evaluated, this is how much cash I have put into the business. Because let's say you've put, I don't know, $5 million into the business. and it sells at 10, your cost basis is 5 million, so you're only going to pay taxes on 5 million. But you can't really do that when you know that there's an impending sale, because then the price, it's so price is when you're pricing something out and you have a third party auditor or you have a third party CPA, think of it as there is like points in time. And let's say there's the point in time when you started and you said the business is worth zero because there's just nothing there. And that's when I got my shares and there was zero. Or that's when I gave them to my employees and there were zero. So it's a non-taxable event. And then there's the time that someone is giving you the price. The closer you are to that price, if you're only pricing it right here, you have to take into a price the price someone's giving you. So let's say you haven't done it and they're giving you $100 million for the business and the shares are now worth $100 a share and you've given $1 million worth of shares, that's going to be a massive tax liability. So that's one piece. The second piece is not setting up like enough of a structure for yourself where, let's say you do sell the business, you hit a home run, you sell it for $100 million, you maybe report your cost basis is 20, so you're going to pay taxes on 80. You know, at that point, you want to figure out how do you lower your tax liability. And there's a couple of things in the US that can help. The first one is something called QSBS, which is QSBS is the qualified small business credit that if you are a founder of a business and you hold it for 5 years and you've acquired it for, I don't know, the stock in the company, or you built your business for under 50 million net value, then you're actually shielded it up to $10 million in gains. That's a pretty sizable thing. If you sold the business for $10 million and you got the QSBS, then it's a non-taxable event for you. But there has to be work to document that the business was worth zero when you got the stock and that you held it for 5 years to report it. So there's that ability, but again, it requires work. And the second work is just to lower the tax liability in general. And that might be putting your shares in a family trust, that in succession planning, putting it in other vehicles that'll lower your tax rate. It's really hard to do that, and to gift your shares in a trust the week before you're going to sell the businesses because they're now inherently going back to that piece of the price. The price is the price. So now the trust has a massive tax liability. So all of that has to be done year, 2 years before. And that's where one of the sort of these big things is what, going back to my 2 points, you don't price it well, but also you need to bring in a team to help because most people don't know how to do this. And this is where a wealth manager, a financial advisor, a good CPA, a good tax person could come in and just sort of, not do the day to day, but to ask as a business owner, hey, if I were to sell today, what's the price? If I were to document, who can I get to do it? And then being able to keep it. That's kind of the number two places that I always see business owners fail at.
Where can people learn more about you and follow you?
I'm big on LinkedIn. You can follow me on LinkedIn. You can go to mendoza-ventures.com. We post a lot on LinkedIn, a lot about podcasts, a lot about selling. We do a lot of education. In our case, we focus a lot on tech businesses, but we also have a nonprofit called Mendoza Impact that also focuses on building programs for small businesses. So we're on Newbury Street in Boston. Every summer, we run a small business program that is trying to get more exposure to women and diverse-led businesses that are on the street and saying, hey, why don't you come? And we will build programming around education, pulling in people in our network to be like, whether it be wealth managers, whether it be consultants, whether it be CFOs, to just do more education on the building out of Main Street. I think everyone in the US and abroad is so excited about tech businesses, but we still always have to care about what is the Main Street businesses and how do we get more small businesses, um, you know, because some people will, there are businesses you invest in that are, tech businesses or they're growth businesses, but there's also great lifestyle businesses that are out there that, will generate great for a family.